Welcome to the Growth House Podcast. I am your host, Jesse Ray. I'm here with Gino. Gino, remind me how to pronounce your last name because it looks a little bit harder than your actually pronunciation is.
Barbaro.
Gino Barbaro. I appreciate you being on the show today.
Thanks, Jesse. And it sounds like you're a New Yorker because you said Growth Ass Podcast. I'm like, good, I'm on the Growth Ass Podcast, not the Growth House Podcast. Okay. But, it's an honor and a pleasure to be on here because I love the title of the podcast, seriously, Growth House. And I think that's what we're all trying to aspire to do. We all think we want to make all this money and become successful. But I think ultimately we just want to grow in our lives. And the more you grow, the more you get involved, the more you find out what your purpose is, that will just lead to more money and to lead to more happiness. So listen, it's an honor and a pleasure to be on here.
Absolutely. So true. Yeah. Everyone on the podcast, everyone listening, want to become the best versions of themselves. And that's kind of like the whole motto. Our motto is you become who you surround yourself with, which obviously is kind of a take on the quote, you're the average of the 5 people you hang out with the most. And with that being said, there's actually a book that's one of my favorite books that I think actually helped you get started into real estate. I heard it on a podcast you were on, and that's Harv Eker, Secrets of the Millionaire Mind.
Yeah. You know, that book, when I read it, I had just lost my dad. It was 2007. He'd passed away, and I had been at the restaurant with him. I mean, I started the restaurant in 1994. So I've been working with him since I was 7 years old. So listen, I've been in the kitchen with him for 30 years at that point, and he had passed away. And I was struggling. You know, the Great Recession is coming on. I'm starting to blame everybody. I'm in my head. And I read this book by Harv Eker, The Secrets of the Millionaire Mind. And the words that really stuck out to me, Jesse, were your fruits are in your roots. And you know, you look at a tomato plant. I'm Italian. I love tomatoes. And you see how beautiful those tomatoes are, right? They're red. The tree is full of fruit. Well, we neglect what's going on underneath the soil, which is the roots. And for me, you know, back in 2008, my roots were shallow, which means I didn't have a lot of value. I didn't have a lot of skills. I was good at what I was doing, but that wasn't going to create more value in my life. And when Harv Eker wrote the book and I read it, I was really, really upset. I was pissed at him. I'm like, how does he know who does he know what? And I'm saying to myself, why am I getting mad at this guy? He wrote the book. He wrote the truth. I can either be a victim and continue on the path that I'm at, or I can say, hey, let me show some responsibility and say that Harv Eker's right. All of the actions that I had taken up to that point in my life led me to where I was. And if I didn't want to change my actions, I would continue along the same path. And I decided it's about time to figure out this multifamily gig, this real estate gig. It was about time to take responsibility. And that book completely changed the course of my life.
I felt the same way. I felt like he was talking directly to me. I'm like, how does he know exactly what I'm thinking? Because I think we all have these pre-notion ideas and we're growing up like, hey, money doesn't grow on trees. And we put out all these phrases that I'm like, wait a minute. I thought that's what I believed, that he like totally switched my mindset. So I'm so glad you mentioned that book because I want to go reread it. And I tell everyone who's just getting started, especially if they don't have the mindset of wealth and abundance and, you know, look at people sometimes who are wealthy in a negative light. I'm like, you guys got to read this book. It's amazing. With that being said, I kind of want to start the story there. I want people to know a little bit more about your background. Like you mentioned, you were working with your dad in the restaurant. I think you're like when you were 7 years old. And then, you know, once your dad passed and you got into real estate, how was that transition? What did you transition into?
Well, it's important to note that when I started with my family, you know, they're both immigrants from Italy. I had certain words around money, right? You got to save money for a rainy day. I always wanted to ask him, what about a sunny day? Well, we just saving money for a rainy day. It was always negative, right? Don't take risks. You know, we have a restaurant. The whole litmus test for my life was, Gino, you're lucky that you have this business because your friends really hate their jobs. So, okay, I'm lucky because I have a business because everyone else hates their job. What kind of litmus test is that? So I was always grown up to, you know, shun risk, to save. And when I read the book, things started changing for me. I'm like, okay, I want to save to buy an asset that'll pay for the event. And I really started exploring my relationship with money. And I think everybody should start exploring the relationship with money. What did you hear when you're 9, 10, 11, 12 years old? Who were you around? And that really becomes, as Harv Eker says, your financial blueprint. And if you're not aware or you're conscious of it, all of a sudden, your blueprint follows you throughout your life. You make money, all of a sudden, it's like a financial thermostat. It's set to 72 degrees. Well, if you make a little bit more than what you normally make, it goes up. But then what ends up happening? it goes back down to 72 degrees. And it seems as if you're stuck there, whether you're making 100 grand a year or 200 grand a year. And if you don't come to that realization, things ain't going to change. And I came to the realization in '08, I've got to learn more. I've got to be able to create more value. My biggest mistake, Jesse, was when I started my business, and this is for all the entrepreneurs out there. I started this business to provide for my family. And that's not why you start a business, folks. You start a business to provide value for your customers and for the marketplace. And if I had truly understood that, I really enjoyed the restaurant, but I was always thinking about it, how much am I going to make? I didn't really appreciate how much value I created for my community. All the bar mitzvahs, all the communions, confirmations, backyard barbecues, the people that came home at 8 o'clock at night from New York City off a train, taking food home to their family. I didn't appreciate how many lives I was impacting, and I was only thinking about myself. I wasn't thinking about creating other solutions for the marketplace. So if you're out there, even if you're going to go invest in a multifamily property or you're going to start a business, you don't do it for yourself. You do it to create value for the marketplace, and the end result, if you're really good at it, is money. Always seek opportunity and value. And the more of those two that you seek and you can create, the end result is you're going to have more fruits. You're going to have more tomatoes on that plant.
So true. I'm curious, when you made that transition into getting to multifamily, becoming, entrepreneur in a different industry, how important was community or mentorship? Was that something that you were, plugged into, or were you mostly just reading the books, listening to the podcasts, that type of stuff?
I'm like everybody else. When you hear of a mentorship program costing $25,000, that's what we charge. I would say to myself, are you nuts? I'm not going to spend $25K in a mentorship. Well, let's go back to 2005 when I met a gentleman named Maserati Mike. He pulls into my parking lot. He's driving this nice gold Maserati, and I end up investing with him. I ended up losing $172,000. Now, if I had spent some money on the front end to learn how to invest, I would not have lost that money. Year later, you think I learned my mistake? I went and bought a deal on my own. I didn't have any experience. I didn't know what I was doing. I was just looking for a deal, like most new investors. Made an even bigger mistake. In 2009, I decided, you know what, time out. I've made all these mistakes. What am I doing wrong here? I went up and I signed up for 2 mentorship programs. And what that did for me was I learned the framework. I always say my life is life before Jake and life after Jake. Life before Jake, there was no blueprint, there was no process, there was no framework. Once I started investing with Jake, I understood what a cap rate was. I understood what due diligence was. I understood how to underwrite a multifamily deal. And oh, by the way, I have continued along on the mentorship program. So now when somebody says 25K, I spend that probably every 6 months, if not more. I think you need to, because you get to a certain point in your life, and then all of a sudden, there's something else you want to learn, whether it's scaling a company or becoming a better leader or becoming a better communicator, whatever that skill may be. We're not born with these skills. And my biggest mistake was I always looked at them as expenses. I never looked at them as an investment. And that's how we're taught. We're taught, hey, public school, why do you pay for school? The thing that gets me is people are willing to spend 60 or 70 grand a year on a college education that's pretty useless, but they won't go out and spend 25 grand to get into a mastermind group that will radically change their lives and learn concepts that we've never been taught in college. So that's the important thing. I think mentorship is everything if you find the right mentorship group and if you're going to do the work. There's a lot of work involved. I can teach you anything you want about multifamily, but you need to do the work and you need to hold yourself accountable. If you can't have those 2 components, don't even think about investing in mentorship groups.
So good. Yeah, I always go by the phrase, it's either mentors or mistakes. You get to choose. And for me, it's all about community. It's all about finding the right people to lead you, that have the fruit on the tree, that can lead you, hold your hand as you, embark on a new journey. Because I thought I was successful as a W-2 employee. And then I made a transition to entrepreneurship. I was like, oh, it's going to be easy. Guys, it's not that way. Like you just said, there's a lot of mistakes. So why not look for the right person with fruit on the tree and follow a blueprint? And you mentioned frameworks. And I'm somewhat new to frameworks, but I love them because they help me, organize my thoughts and also, take steps forward in the right direction, doing it the right way. What are some of the frameworks that you would suggest or you like to share with people who are making that transition into entrepreneurship or as a real estate investor?
Well, let me share 2 with you. And they're about multifamily. The first one is really about becoming a passive investor. Because if you're a W-2 employee, the whole, market in the last couple of years was people were raising capital for tons of deals in real estate. And limited partners now are getting capital calls. Some deals are being foreclosed on. And listen, my very first deal with that Maserati Mike, I was a passive investor. And remember what I said? I was pissed off. I was a victim. I was blaming everybody. Well, Maserati Mike was a dirtbag. He's still a dirtbag. But that's not the reason why the deal went bad. The deal went bad because I didn't understand how to invest as a passive investor. I didn't understand how to invest in real estate. So if you're here and you're wanting to invest in real estate, you just don't have the time. This framework is crucial for you. We call it the 3-step framework for passive investing. The first step is don't look for the deal. That's what every investor looks for. Let me look for the deal. No, you're looking for the sponsor. We call it the jockey. The jockey is the most important part of this puzzle because the sponsor or the jockey is the one who's going to be driving the deal. Do they have experience? Do they have credibility? Do they have skin in the game? Do they have a business plan? That's what you should be focusing on, the very first thing. The second part is the saddle that the sponsor is sitting on. We call that the alignment of interests. Now, if you are, interviewing certain sponsors and these sponsors are charging high fees and they're turning these properties over and they're worried about themselves and not looking about what your interests are, that's probably not a good sponsorship group. What you need to know is you need to ask them questions and say, hey, how does this deal work for me? How long are you keeping my capital? What is my rate of return? What type of communication do you have? You make sure as that passive investor that your goals and they align with the sponsor. If they don't, I don't want to hear a sponsor saying to somebody, this deal has really little risk. You're going to 2x your money in the next 3 years. That's not real estate. Every investment has risk. If you hear that from a sponsor, don't walk, run away from them. I mean, that's important for you guys to understand. So you've got the jockey, you've got the saddle, and the final part is the horse itself. That's the deal. Once you like the sponsor, you've seen they've had experience. You've seen they've gone through a few deals through market cycles. You've seen that their interests align with yours. You're getting a really good deal. You feel really good about the fees. You like the IRR. You like the business plan. The deal is the final component. Does the deal make sense for you? Do you understand what the deal looks like? And in that part of the deal, that's where our framework for multifamily investing, and I think the framework for any kind of investing, whether you're buying a business, a single family home, we call it the buy right, the manage right, and the finance right. That's the 3-legged framework when you're investing in real estate. And let me just expand on that real quick. This is another one where let's picture a wheelbarrow. Jake's in his driveway. He's looking out in his garage and he sees a wheelbarrow sitting there. And he's like, the 2 back legs are fixed. Well, that's the buy right and the finance right. Once you do both of those, they're fixed. You don't have to take care of it anymore. Your wheelbarrow is stable from the back end. That wheel of the wheelbarrow is in constant motion. That is the manage right. That is where most operators and most investors and most sponsors fail because they think that multifamily is just you buy the deal and you let it go. You become an entrepreneur when you get into multifamily real estate. I think you become an entrepreneur when you start investing in real estate, period, because it's such a beautiful, scalable business, but you need to tend to it, whether it's asset management and or property management. And I think most people forget about that. And that's why people have been having trouble in real estate. So think of that framework from the buy right, manage right, finance right component. And if you're looking to buy a business, it's the same thing. You're going out and buying a business. Well, what are you buying it for? How are you getting the financing? And who's going to run the business? So when you're looking at it from that lens, the investment makes sense, and you will, in my estimation, cut down your risk dramatically if you use that framework.
I love that. Let's talk about the jockey real quick. So you already mentioned one red flag. Hey, this has no risk. It's going to double your money in a couple of years. What are some other red flags that you would advise people to run away from when talking to the jockey?
Yeah, well, when you talk to the jockey, you have to understand that if you've got 50 grand in the bank and those are your life savings and that jockey's trying to pull that 50 G's away from you, I would never do that because I know that person, if that deal goes bad, that person is getting wiped out. You have to make sure that this is additional funds that you could potentially lose. That's the alignment of interests part. When you're seeing a jockey is really desperate and really pushing, that's important. The other thing is I want to spend some time with the jockey. I want the jockey to get to know me, to get to know what my goals are, to get to know, hey, is it okay? Mr. Investor, if I hold your money for the next 5 to 7 years? Because real estate can be illiquid, especially in this part of the market cycle where deals were trading, the last 3 or 4 years, every 18 months. Well, now we've had a slowdown and deals are being held longer. So is it okay if I can hold your money in the next, if it's not fine and you need that money back in the next couple of years, then hey, that's not okay. And another thing that I found out that was a really big KPI, key performance indicator, this past couple of years, if you got into real estate in 2018 or 2019, as cap rates were compressing, going down, you could have had zero, what we call net operating income growth, and you still could have sold at a higher price point than what you bought it for, just as a function of the market. Now, things have slowed down. So you may say to yourself, this jockey's been doing great for the last 3 years. Ask the jockey, what has been your net operating income growth over the last few years on each property? And that may take them for a loop. They may say, I don't know, or they may fumble. That's important, because if they've got zero NOI growth, guess what? Going forward, you're not going to be making money on those deals. So understand how they've been creating value in those deals. It's really, really important that you understand that. I mean, there's so many red flags. If a jockey doesn't want to spend time with you, or if a jockey can't answer certain questions, then there's a red flag. Now, you can ask Jesse, you can ask me a question and say, hey, Gino, what's the median income of that market? I can say, hey, Jesse, I don't know, but I'll get back to you. So that's something I'm totally cool with, because if somebody knows the answer to every question, then you have to be a little worried about that. And Jesse, another thing I would say is, hey, Mr. Jockey, do you mind if I speak to a couple of your investors? I love to know how you communicate with your investors. I love to know the rhythm, the cadence of accountability that you have. Do you have monthly webinars? Do you have monthly newsletters? Do you have quarterly touch points? Can I go out to the property and see the property? What I would tell every potential investor, if I'm a passive investor and I'm investing with Jesse, I'm going to find out every single person on Jesse's team, whether it's their property manager, their CPA, their cost segregation, their syndication attorney. Find out everyone who's on the team, vet every single person on that team, and then start calling other properties that Jesse manages or controls and see the systems and the processes with that. Now, once again, it's going to cost a little bit of money, but why not get on a plane, spend $500, fly out to that potential property, not even with Jesse, but walk around the property and walk around the neighborhood and get a feel for it, because you're putting 50 grand, 100 grand, 200 grand. No like and trust don't work in that situation, because no like and trust ain't giving you your money back in 2 years if that deal goes bad. These are all things I wish I had done. That's why we've launched this program called Passive Investor Pro, because I'm sick of LPs complaining that GPs suck, and I'm sick of GPs complaining about the market. We all have culpability. We're all to blame in this market cycle. I want stronger LPs, because the stronger LPs will hold these sponsors and jockeys to account, and these jockeys will not raise money if these deals suck, because the LPs they'll be more educated. So these deals, prices will come down, LPs will get better, and guess what? Jake and Gino can continue to buy deals because the deals won't be overpriced. So that's really the whole genesis and the whole reason why we're doing this, because we want strong LPs. We want people to make educated decisions, and we still want them to be passive. I want them to learn the business as if they were actively running the business, but having the passive mindset of saying, once I've got the framework, once I've got the foundation, I know what to look for. Whether it's a sponsor, the market, the deal. Once I hone that all in and I understand what I'm looking for and I understand how to do my due diligence, then I can start investing with Jesse and give him the keys and give him the capital that he needs to close this deal.
So good. If you're listening to this and you're about to invest, do this due diligence, go back, repeat this 3 to 4 minutes, because this is what people need to hear, because I hear the same thing all the time. Oh man, the deal didn't work, the GP, whatever. It's like, well, did you actually follow through? Did you go walk the property? This is so good. So guys, re-listen to this. What I want to ask you about the jockey as well, because I hear this a lot. If they don't have personal money invested, then it's probably not a good deal. That's
a great question. It can go both ways. So let's say your jockey has no experience. It's their first deal, but they fund the deal. And if they lose this deal, they get wiped out. Now, do you think that jockey is going to work harder, or the jockey who has 17 deals in 3 different funds? And if your little deal loses, is he really going to lose sleep? That's a personal question. You have to weigh one against the other. I personally, and this is what pissed me off about Maserati Mike that I didn't understand. I gave Maserati Mike my money. Maserati Mike had no skin in the game. He was probably using my money to pay his payments on his car and his lifestyle. So when the deal went upside down and we lost the deal, Maserati Mike was nowhere to be seen because he didn't lose anything. So it's really important. I'd like to see sponsors or jockeys put skin in the game. I want at least 10% of their money going in. And sometimes when a sponsor or jockey has a deal, they incur fees. They charge acquisition fees. I'd like to see a little bit more money than just the fees that they earned on the deal go into the deal. That's just my personal preference, because if that deal goes south, they're going to work their ass off to straighten the deal out. Now, that's, like I said, once again, that's personal preference, but I've been caught where the sponsor had no money in the deal, and it was just so easy to say, oh, well, the market, what are you going to do? But if the sponsor's got 10 or 15% of his own equity in that deal, I think he's going to work a lot harder. And I guess whether it's extending the loan, whether it's working with property management, whether it's rolling up his or her sleeves and going to work on the property and sitting in that office and leasing units themselves, there's a better chance of that happening than if somebody has no skin in the game.
Skin in the game is so important. I love that answer. As far as someone who's just starting out, they want to get into multifamily, would you say they should be an LP first, learn the process, have money invested, watch the GP do their work, and kind of see how it's done? Or what's the route that you would say if someone wanted to start into multifamily?
That's another great question. I would personally say, what are your goals? I mean, if you're a doctor, you're working 70 hours a week, and you want to get into this thing full time, I would probably do a couple of passive investments first. There's no bandwidth, but once again, jakeandgino.com/apply. Learn how to passively invest. Spend a few bucks up front, learn the process, and then invest passively. And then at one point, when you feel comfortable and you have the time, then you go into the mentorship where you're going to learn that 3-step framework and then say to yourself, there's so many ways to get into this business. You can, what they say, co-GP, where you're partnering up with other people on their partnership team and become a co-sponsor of a deal. So you can raise money where you're not running that deal all by yourself and you're getting some experience. And then all of a sudden, 2 or 3 deals down the road, you may become the lead sponsor. Or you may find a partner like I did with Jake and say, hey, Jake, let's partner up. You want to leave your business. I want to leave my job as well. Let's do some deals together. And hopefully down the road, we'll be able to, buy a couple of deals and possibly leave our jobs. It really comes down to, I think, personal preference, what your goals are, the time that you have allowed to allocate to it. For me, it was just, I need to leave my restaurant. I just was stuck there. I needed to find it. So for me, passively investing, I would not have been able to create enough equity to do it. But it's a great way to actually use some, if you have some money in a retirement account, you're 39 years old, you ain't touching that money for the next 20 years. Put it into a self-directed IRA account, invest that money passively, because you can't self-deal. You can't use that money for your own investments, but you could possibly go out and invest in someone else's deal and see how it works. Then all of a sudden, when you're speaking to a broker or another investor, hey, I'm an equity owner in this 120 unit complex, they don't have to know that you're invested passively. You still are a part owner of that deal. Maybe it's 1 or 2%, but it at least gives you the credibility to be able to talk to brokers to say, hey, I'm already invested in multifamily.
You mentioned partnership, and obviously you guys have a great partnership, Jake and Gino. Talk to me about how that formed, and also how did you guys vet each other?
I personally think that if you can't sit down and have a beer with your partner, then you shouldn't be in partnership. That's just my personal opinion. I've been in partnerships with people that I don't like, and it just doesn't go well. For us, it was pretty simple. He was a hardworking, faith-based family guy with a long-term mindset who was willing to really grind his face off and not let me down. And I was practically the same way as he was. It was basically what we call now values-based decision-making. If you're going to partner with somebody that your values align. We're both hardworking. We're both dedicated. We're both not going to let ourselves, give up on the other person. So we held each other accountable. And it's an easy thing to do. This past Friday, I flew out to Knoxville Friday morning, came home Friday night. I had to do some videos in Knoxville. I can't say to Jake, oh, well, I can't make it. I'm not flying in. Well, no, you just get on the plane and you do it, right? It's very simple. In December 18th of last year, I'll never forget it. It was a Friday before. This is the week of Christmas. And we're doing a 97-unit deal. And we're working with a new bank. And they needed wet signatures. I'm like, bro, they need wet. This bank had never done business with us. So it's the Friday before Christmas. I'm like, dude, he says, you got to fly to Knoxville. So for 3 seconds, I'm like, I ain't going. I felt like a little child. But then I'm like, you know what? He did all this work. He put this whole deal together. We may jeopardize this by a day or two. We may lose the deal because I don't have wet signatures. So what did I do? I did what any responsible partner would do. I booked the flight for Monday, got on the flight, flew out there, signed some docs, and flew out the same day. And that's what you need to do. If you're not willing to sacrifice and to commit to a partner, don't even think about going to partnership. That being said, multifamily or scaling any business is a lot better when you have somebody there with you, because it can get lonely as an entrepreneur. It can become tough. I can get on the call with him and say, hey, I'm having this challenge. Help me out, because he can see it from a different perspective. He has capital. He makes my balance sheet stronger. I make him stronger. But just make sure that you partner with somebody that aligns with you, that aligns with your values, because Jake is not going out and buying crypto, and I'm not going out and buying single family homes. We're focused in on multifamily, and we're focused in for the long term.
I want to dive into multifamily a little bit more, why you guys decided on multifamily. But before that, the roles. I always hear people say, hey, have a visionary and then an integrator, or someone that kind of complements your, strengths. Is that what you guys did as well? What's the two roles that you guys play?
It's interesting because I think we go back and forth, because I think we can both be visionaries and integrators at the same time. And people say, well, that's not possible. I truly believe it to be, because I am more of the visionary on the education side. That's where I spend my 9 to 5s. Jake is more the visionary in the property management side. He drives that side of the business. And then I can look from the outside and go, we should be doing that in property management. There's this company called Property Meld. Let's use them. Hey, what about AI for property management? Because when you are in the weeds, you can't look outside. And when we're doing this podcast with Jake and Gino, it's like, wow, he gets his inspiration. So we really, blend each other. When we first started out, it was the I'm a mentality. I'm going to do this. I'm going to do that. We're all going to do everything together. And as you grow, you start gravitating towards what you really enjoy and what you're really good at. I started gravitating towards the investor relations when we were syndicating, creating a brand, putting out content, writing books, creating the Jake and Gino community. And then Jake was just gravitating towards the operator. He liked to property manage. He liked working on the assets, and that was his backyard. And for anybody, thinking about getting into partnership, in the beginning, it may be difficult. You may have to wear multiple hats, but you'll see as you start growing and as you start hiring more, you'll start delineating those responsibilities, and you'll start gravitating towards, what you really like, but you still will cross paths all the time, because you want feedback. You want to be able to find out what you're doing wrong and what you can be doing better.
Gino, like I mentioned before, our audience is mostly high income earners. Let's say 6 figures to $250,000 in W-2. In today's market, with all these different asset classes, what would you say would be the, I guess, maybe not best, but fastest way for someone to replace that type of income on a monthly basis?
Great question. I just think, Jesse, I don't want to come out and tell everybody that multifamily is the best vehicle. To me, it is. And it worked for me because as a pizza guy, I'm working already 55, 60 hours a week. I couldn't buy a house or 2 houses a year or fix and flip. I already had a job. So for me, I was like, let's buy a complex, whether it's 10 units or 15 units. They're all in one location. You only need to buy 1 or 2 a year. I mean, could you imagine buying 7 or 8 or 10 homes a year, doing the transactions? I just closed a transaction last month. What a nightmare between the inspection, the taxes, the insurance, the closing statement, the walkthroughs. It was a nightmare to do one transaction. Can you imagine doing like 1 or 2 of those a week to try to scale and flip homes? I couldn't do that. So for me, we settled on multifamily early on, saying, hey, if we could do 1 or 2 deals a year, by the end of year 5, we've got 7 or 8 really good deals here. And that's what ended up happening. So on our very first transaction, it was a 25-unit deal. All 25 units in one location. Jake is driving around. He's a drug rep for Glaxo. So during the afternoon, going out collecting rents, showing apartments, and it's one location. It's 25 roofs. It's one lawn to cut. It's one property tax bill, one insurance bill, one loan. That was what really worked well for us. And then from there, we were able to scale. 3 months later, we bought another property. And what we love about multifamily is you can start hiring management and maintenance techs. It's very difficult when you have 3 or 4 or 5 homes to go out and find property management and it's people that do handiwork. It's just very difficult to scale that. But with 2 or 3 transactions in multifamily, you can already have a payroll that's helping you out.
I love the scalability factor because I have not invested in multifamily yet, except I
Mm,
do co-living, which is kind of like a blend. I like to say
yes.
it's like you get single family appreciation, but you get multifamily cash flow because you're
Yeah.
renting out by bedroom. So I'm in the process of scaling. I'm like, man, I'm running into the same things that you just mentioned. So with multifamily, what would you say is the biggest difference between multifamily and single family when it comes to how you're able to sell on the other side? Because how you sell is completely different from my understanding. Is that correct?
I love the question. There's some really big differences. And Jesse, to the point, I can't say that multifamily is the best business because I'm down here in St. Augustine. Believe it or not, short-term rentals down here have been phenomenal the last few years. And if you have a small portfolio of short-term rentals and you run that as a business and you have a property management company and you have a little real estate brokerage and you have some short-term rentals, that's phenomenal. And what you're doing is phenomenal also. The scalability is difficult. The two biggest differences between single family or residential and commercial and multifamily is, number one, in the multifamily space, we don't have an MLS for larger deals. You may find a 20 unit or a 30 unit on the MLS, but it's really broker driven. You need to create relationships. That's important. And the second component is the financing aspect of it. We have shorter term loans that come due. When you're buying a residential, you may buy a 30-year fixed loan. It's amortized fixed for 30 years. After 30 years, it gets paid off. We may have a 30-year amortization in multifamily, but it may, the term may end up after 5 years, 7 years, 10 years, that loan comes due or it resets. It may be a balloon payment where that whole loan is due. And what do you got to do? You either have to refinance it or you have to sell it. And you've seen what's gone on in the last couple of years. We've always preached long-term fixed rate financing, and this bridge debt has come to really harm a lot of people in the last couple of years because they thought, I'm going to buy this short-term debt, which is fine, but interest rates are low. When interest rates rose, all of a sudden you're having an asset that appreciated a little bit, but all of a sudden the cost of capital went from 3% to 8 or 9%, and now you're caught. And not understanding your exit strategy is really, really important. The other component about co-living, that maybe you can clear this up for me, but what you're trying to do with multifamily is you're trying to create a portfolio where you have an exit strategy. There's a lot of end buyers for what my product is. So I can actually think to myself, hey, when you make money in real estate is when you actually crystallize the equity from a sale or from a refinance. Everyone says you make money on the buy. You may make money in the buy, you may make cash flow, but you haven't crystallized the exit. It's like buying a stock at 10 and it's at $25. Have you made money? You haven't realized it. It's a paper profit, but it's not realized. It's the same thing with real estate. You need to exit that asset. So in the co-living space, if there's not a large pool of buyers, or let's say the RV space, or the mobile home park space, or whatever space you're looking at, or your market, you may have a small market where there's not a lot of demand. Understand that as part of your exit strategy that you may have to hold that asset for a little bit longer. There's nothing wrong with that, but understand that it may be harder to find property management in these smaller markets. So understanding that, for me, that's why I love multifamily. There's a big pool of buyers. There's a big demand for it. And like I said, once you create those exits and you repurpose that capital into the next deal, that's how you can really start scaling up your portfolio.
You're so right, because I'm looking at the co-living model, and there's now becoming more and more investors interested in cash flow. Like like one of my properties is about $8,000 of rental income, and then with where my mortgage is, it's like $5,000 of cash flow. It's pretty nice. So there is some people that are interested in that. However, there is not a large pool yet. But for you, from my understanding, with multifamily, there's a lot of people that want to get into multifamily that would like that. So I guess my question is, how do you, when there's not that many comparables, how do you exit? How do you basically base your numbers on what is this about to sell? Because I know you do a lot of value adds as well to your multifamily.
Yes. Jesse, what I love about your strategy is we call it the conveyor belt. And think about a conveyor belt, a 5-year belt. And what you're doing is you're creating cash flow, right? That's a strategy. You're putting assets on this conveyor belt, and the conveyor belt may matriculate and it may not, but it's growing. So someone says, oh, I got into single family homes. Well, you've got some single family homes on this conveyor belt. You can pull that equity out after 3 or 4 years, sell it, and get into the next deal. I love your strategy because you've got that cash flow. That right there is going to pay for your living expenses. Why not keep that and then get into another asset if you like? I think people miss the point by saying, oh, I'm not going to get into real estate because I can't get into it, or I'm doing single family homes. Great. Just think about getting assets on this conveyor belt. Let the work do itself. And then 2 years from now, you'll be like, oh, I've got 3 or 4 deals on here. It's time to sell these or refinance these, pull that capital out and go into the next one. Basically in multifamily, the way you increase value is by increasing the net operating income. Net operating income is your gross net income. You're subtracting your operating expenses. That gives your NOI. NOI, right now, how you're increasing NOI in multifamily, typically right now in this part of the market cycle, is through operations. Everyone's been doing renovation. Everyone's going in, buying these properties, spending $10,000 per unit, raising the rents. Well, where we are right now, it's going to be very challenging to do that because where the prices are and where we are in the market cycle, it's a lot more challenging. So you're going in, you're trying to, I don't want to say eliminate expenses, but reduce expenses. If you reduce expenses, you increase your net operating income, and that's how you increase the value of the property. It's not like it is in residential where you're looking at a property that's selling for this, mine's selling for this. If you can increase that NOI through efficient operations, or even through increasing rents, increasing additional income. We're buying a property right now that's a 2019 build. This seller has, out of the 67 units, he's got over 30 of them on their own separate meters. 37 of them are master metered for water. He's paying water about $5,000 a month in utility expenses because he's a mom and pop. We're going to take that $5,000 a month and we're going to bill it back to the residents, and they're going to pay it because it's a brand new build, and that's what you do in multifamily. So if you take $5,000 a month times 12 months, it's $60,000. If you divide that by a 5 cap, it's $1.2 million in value that you just created just by pushing back. And you see why multifamily works, the scalability? That's on 37, that's on 67 units. Can you imagine if you have 167 units or 1,000 units? A $10 increase in NOI across your portfolio has massive implications.
I'm going to take a slight pivot. You mentioned something to me. You said baby money soldiers. And I think it's a great, because you also paint a picture when you describe this. I love for my audience to hear about this.
We're launching the book. It's coming out in a couple of weeks. And it was on a podcast. Same thing. We're just sitting there riffing with a guy named Carmine Gallo. He wrote the presentation secrets of Steve Jobs. And he was always talking about when you communicate, you have to try to really communicate in simple terms, like dominoes, get it there in 30 minutes. Jake and Gino, we create multifamily entrepreneurs. So we're always trying to create these visuals, and we're trying to simplify personal finance because honestly, Jesse, it's not rocket science. This is stuff we haven't been taught. So Jake is sitting there one day on the podcast. He's got a dollar bill, and he's like, you have to take your baby money soldiers, and what you want to try to do with these baby money soldiers is you want them to procreate. Now, let's take a step back. Hold a dollar bill. A dollar bill is a baby money soldier is any dollar that comes into your life, any income that you make. Now, how you spend that dollar bill or how you invest it really determines your financial intelligence and what ends up happening down the road. What we typically do is we take a portion of that baby money soldier and we use it for an operating expense or living expenses. We take a portion of that and we use it for luxuries. Cars, vacations, jewelry. Well, those baby money soldiers are dead, right? What's left? We can still use some for charity. We can still use some for education. We can still use them for investing. We should have some pulled back in reserve because if something happens, if there's an opportunity, we need to use those baby money soldiers, right? It's really important how you understand it from that perspective. It's so simple. And we like to think of it as the battlefield. You are the general. You are in control of your baby money soldiers. And your job is to go out like the game of Risk and start taking over properties. And once you buy a property, all of a sudden that property is cash flowing. Baby money soldiers are coming from that. What do you do with them? Do you redeploy them into other deals? Do you pull some back in reserve? I like to use whole life insurance for my reserve. I put the money in whole life. Whole life's doing a few things for me. It's helping me with my estate plan going forward, and it's also a reserve policy where I can borrow and attack more. Once we do that refinance or that sale, all of a sudden those baby money soldiers come out. What do normally a lot of people do? They kill them with luxuries. They go out and spend them. What I want you to do with that money is to go out and to buy another deal to procreate and to create even more baby money soldiers. So you see the snowball effect that this can have. And I think if you laid out that simply to people, they'll say to themselves, well, do I need to buy the car? I'm not sure. And the reason why I was able to leave my job within 5 years with Jake was I was working at the restaurant. I was still making money. That was paying my daily expenses. The first 5 years of our, real estate education, investing, I was making money in the real estate. I was putting all those baby money soldiers back into the business, buying deals, reinvesting the cash flow. I wasn't living off of that. So I was able to really accelerate my baby money soldiers and the ability to continue to grow the portfolio because I wasn't killing them. The job, my restaurant was actually paying for it. And, the investment itself was taking care of it. So if you're out there saying, I need to quit my W-2 and I need to go into real estate full time, do you have to? I don't know if you have to. Sometimes you might want to do it mentally by saying, hey, burn the ships, burn the bridges, whatever you want to say. But sometimes prolonging it and actually being able to invest the capital that you have from these deals to procreate and to create more baby money soldiers may be more beneficial to you.
Gino, that's a mic drop, and I think I might steal that visual because I love it.
You should.
So, Gino, there's going to be a lot of people in the Growth House family that is going to want to reach out to you. But we're a bunch of go-givers, community of go-givers. We want to provide value first before we ask for anything. So if someone reaches out, they say, hey, can I pick your brain? Ignore them and then let me know because I want to talk to them. So what's something that someone can reach out to you and provide you value before asking anything?
That's a great question. I've never been asked that question before in hundreds and hundreds of podcasts. I would love if people reached out and just asked me a question about they're struggling with, because then I can create a how-to or a video. Because sometimes when you're in the weeds and you're in multifamily, you've been doing it for so many years, you just lose sight of what's really important or what challenges people are having. Like somebody may say, hey, these high interest rates are killing me. I can't get into multifamily. And I would just say it has nothing to do with interest rates because interest rates are high for me and they're high for Jesse. That's not what's holding you back. So if somebody wants to reach out, just ask me a question and that would give me the impetus, or it would give me the ability to create content that's speaking directly to you, the investor. And it's also speaking to others, because I'm sure if somebody has a question, there are a lot of other people that have the very similar question that you do.
I love that answer. I'm going to add two more things. Let Gino know what value you got out of this podcast.
That'd be great.
Also, let him know that you left him a 5-star review on Jake and Gino's podcast because they have a podcast themselves. With that being said, as we wrap up, Gino, what are the best ways people should reach out to you?
Jesse, I would just say go to jakeandgino.com. If you want the PDF copy of our book, Wheelbarrow Profits, email me, gino@jakeandgino.com, and I'll send you a PDF copy. It'll give you the framework to get started in multifamily. You can use it, like I said, whether you're in multifamily. We had a student who just closed a self-storage deal the other day. He's like, industrial flex. All our students, once they learn the framework, you can just translate it into different genres of real estate. But the framework works. If you want a copy, email me, gino@jakeandgino.com.
Gino, it's been a pleasure, man. Growth House Podcast. I'm your host, Jesse Ray. And our motto, you become who you surround yourself with. And I'm honored to surround myself with Gino today for the last 45 minutes. People are going to reach out to you, and I appreciate you.
Pleasure, brother. Thanks.